my golly, are you going to get yourself a deal? You should be paying me for this one. This is a gold mine. So for you, Daniel, I'm sure you have some unique strategy to lease up that most people don't know. And if you don't feel totally comfortable sharing,
I feel totally comfortable, David.
Let's go.
You've made me feel totally comfortable here. I appreciate that.
3, 2, 1.
All right. Man, what an honor and a privilege to have Daniel here with us today. Daniel, believe it or not, was one of my first real estate mentors. It was right around the time he got started in his own business as a real estate investor. At the time, he was working at ZS Associates.
Correct.
He quit there to chase his dreams, and I was just learning about real estate, right? And we ended up linking up, and he just, from the very moment I met Daniel, he was a go-giver. He was just pouring into others, mentoring others, and I think that has a lot to do with the tremendous amount of success that he's had. So, Daniel, 8 years later, thank you so much for making the time today. How you doing?
I'm doing great, David. Thank you. And, 8 years, right? It's been a long time. I think you were in college. I was just getting started, as you mentioned, 8 years ago. But, cheers to you, brother, because I'm so happy to see your success 8 years later. And I'm just thrilled for everything you've accomplished. Not surprised, because I knew what would happen, but really happy for you. So cheers to that.
Cheers.
Thanks for having me on.
Of course, it really is my. I'm so glad you said yes, because a lot of people that we know when they've done really well for themselves, they're like, I'd rather keep a low profile. But I'm thrilled that you're here. I'm sure the audience is going to get a ton of value and wisdom from your lessons and the lessons that you've learned throughout this entrepreneurial journey. For the audience and for me, can you just give us a little background on who you were before real estate?
Yeah, sure. Yeah. So, I've always had real estate kind of in my family a little bit. So starting with my grandfather, my mother, we owned a property or two here and there. So I was always exposed to it. As I got older, I was a little bit more involved with those properties. But professionally, I have a management consulting background, got my MBA, went back to consulting, a couple of other things along the way. But, real estate was always there. It was always, that passion that I was trying to do it on the side for a while I was doing consulting. But between the travel and the long hours, it just wasn't happening. So there was a moment when I decided to take the leap from consulting to real estate. And you're not going to believe me when I say this, but that moment was exactly to the day 11 years ago.
No way.
And the reason I know it was to the day is because yesterday was my daughter's 11th birthday. Okay. And 11 years ago, the day after she was born is when I kind of had, so the day she was born, I was like, I had a baby, whatever.
Yeah.
But the day after that, I was like, all right, let me reevaluate my life now. Right. So it's a good time to do it. And I thought, all right, what kind of life do I want to have? Right. Do I want to be traveling? Do I want to, all this stuff? So, there's a lot that I enjoyed about consulting, but I wanted to have more control of my time and basically spend that time doing what I was passionate about, which is real estate. So people said it's crazy, it's the worst time to do it, you just had a kid, whatever. But for me, that was the best time, because this is where life is sort of showing me two different paths, right? So that's when I decided to jump in full time.
That's awesome. I appreciate you sharing that story, Daniel. Happy birthday to the daughter, and cheers to that. I'm glad that you said that you had tried to do real estate while working a full-time job. A lot of people, they're like, David, I want to quit my job. I want to quit my job, and I want to go do this all in. I say, dude, slow down. You have a job that pays your bills.
Right.
Why don't you start doing it after hours? Why don't you start doing it on Saturdays? But given that, management consulting is a very, very difficult. It's probably one of the hard. It's like close to investment banking. You're traveling. You're working odd hours of the day. So I understand why you had to make that leap. Did you have any success on the side while you were hustling on the side?
I mean, I had one property that I owned, and I had third-party management, and it was, so I could have maybe bought a second one, but that was it. I mean, there was a cap to what I was able to do, and but I was really interested in developing that as my career. So, it's not something that can just be done in nights and weekends, really.
Yeah, no, I learned that pretty quickly. You'll get a deal locked up, and then you're working 80 hours a week. You're like, holy shit, what happened to that deal?
Exactly.
Awesome. So, from your experience, you're an educated man, MBA. I think you went to some pretty good schools too, from what I remember. You're a Wharton guy, right?
Wharton guy, MBA, yeah, Harvard undergrad. Yeah.
Come on, he's come on, flex on the gram a little bit.
No, it was a long time ago. I'm old now. It doesn't count. It doesn't count anymore.
Oh man. So Harvard grad, very smart. I mean, incredible accomplishment in itself to just get accepted. Once you're there, it's a little easier, I hear, but just to get through the door is an accomplishment. But from your experience in corporate and your education, and now 11 years tenured in the business, to you, what is a good deal?
Well, great question, David. That the answer's changed over time, right? So, and it's changed with the market, and it's changed with what my own goals were. 11 years, even 4 years ago, you were able to buy a nice, clean property, a multifamily with nice cash flow and upside. And that's changed. I mean, right now, based on rates and how the market's gone, you have to really rely on that upside. So I started out buying small multifamily, and it would cash flow nicely from day one, and then it would also have upside. And then the market also moved in the right direction. Now, so I should say I haven't actually bought anything in the past year because of where things are and because I'm really busy with all the properties that we have. But prior to that, I was seeing good deals in office, the kind of the unloved asset class, and some mixed use. So looking at things that not everybody's looking at, and looking at more upside versus cash flow.
Interesting. Yeah. How has that treated you, the office play?
Listen, I mean, everyone was down on office, especially during COVID. Work from home phenomenon is going to take over. Office is dead, and maybe it was dead for a little while, but it's case by case. It's market by market, submarket by submarket, building by building. I'm not talking about office buildings like the one here where you have your office. I mean, smaller buildings, and I was just able to find. That's really the only place I was able to find cash flow, and the upside wasn't clear whether there was going to be upside or not. But when everyone says this is a terrible idea, you're going to lose all your money. So okay, so let's quantify that. All right, what does that mean? Does that mean I should just plug in a different number in my spreadsheet, right? I should say, okay, maybe the rent per square foot's going to be a little lower. Maybe the vacancy is going to be a little higher. But we can work with that. We can come up with, so the numbers might still work. So there's this whole the sky is falling thing didn't really happen. Short answer, yes. So especially, the office building where I have my office, we bought it 2 years ago with about a third vacancy, and now it's at full occupancy with higher rents, because it just, it worked. The numbers worked. The location was good. So we were able to overcome some of these challenges that everybody's talking about.
Yeah, true contrarian, man. I'm terrified of office space. The fact that you jumped in when there was real blood on the streets, you probably got some good deals.
Yeah, it's I didn't take unreasonable risk. I think first of all, a lot of the stuff, a lot of the tenants we have are medical. So that's a different kind of office, right? That's much more resistant to these negative factors, right? So often, and there's some personal services. So we actually have newer tenant in our building is cannabis dispensary. So that's obviously a big opportunity in the past year or so. We got lucky because the town designated that neighborhood for a dispensary. So I started getting calls from brokers saying, I have a client that wants to open a dispensary and they have to open it here. And I thought, okay, I didn't know that when I bought the building. So that I got lucky on. But something like that is just, is a pretty solid tenant along with the medical tenants.
Yeah, medical tenants are fantastic.
Yeah.
Did you have any challenges raising capital for this asset class?
Not so much raising capital. More the challenge was on the debt side. So the banks, past couple of years have gotten pretty tight with lending. The LTVs went down. They started holding back escrows. They started, asking a lot more questions about the leases and so forth. So it's been a process of kind of proving, proving that we can get those vacancies down and we can, and we're able to do it. But it was more of a challenge on that side, on the lending side.
Got it. Were prior bank relationships help at all, or these were new lenders that you had to reach out to?
No, they help for sure. And that's one of the things, like when I was starting out, I don't know if you can relate, but I thought okay, I'll shop around everything, from lenders to electricians to plumbers. I'll just, I'm going to go to 10 people and get the best price. And then I realized, one of the lessons learned right over time is that relationships matter. And when you work with the same bank, now I have 2 banks really. It's not always the same bank, and I have 2 plumbers, but it's not 10. And those relationships matter, and you will get a better price, and you'll get better service, and you'll have someone you can trust. And that's worth more than maybe once in a while you save a couple bucks on one deal, but it's worth it to have the relationship.
You're absolutely right. Some of the best people, like I still shop. I do. Largely because the beginning of my career was hard money DSCR products. But then once rates started going up, I couldn't get out of my deals with the DSCR interest rates were. So I had no choice but to go to local banks,
right?
Fannie Mae, Freddie Mac. And so now that I'm really learning about how difficult it is to get bank financing and not, stated income loans.
Right.
Yes, absolutely. Those relationships matter. And when things get really, really hard and other people stop lending, if you have that relationship, those relationships could save the day.
Right.
So,
absolutely.
Yeah, that's great wisdom there. Starting off in the beginning of your career, I want to just rewind a couple seconds. You did one deal. You had one that was being third-party managed, right? Obviously, you're brilliant. You have a track record in one of the best management consulting firms in the world, best universities in the world. So I'm sure people trusted you and that you're highly intelligent. But going out and raising capital with no real track record, that must have been freaking hard for your first few deals.
Right. Well, the first few deals is really friends and family.
Yeah.
I think so that's, and that's has its own risks, right? You don't want to, you care about your friends and family's money more than your own. So that's, you're highly motivated there to make it happen. But yeah, that's where it starts. And then just kind of one degree removed from that, friends of friends, friends of family, that kind of thing.
Was it difficult at all for you or because for me, raising money in the beginning was probably one of my biggest nightmares.
Well, I started pretty small. I mean, it was a very gradual entry into this, which is a nice way of saying I made no money the first year. And I tried to build credibility by doing everything myself, or everything meaning the management myself, like on the first property. So, I went from managing it myself to hiring a management company to having an employee of my own as a property manager. That was the progression. But I think starting with managing myself, not only did that help me, it was a source of revenue, although small, but it helped to build that credibility, saying I am hands-on at this property. I know everything happening.
Wow.
More than I want to know. But that, even that at the beginning, that helps you raise money, because you're just, you've all the skin, not just skin, you have all your skin is in the game.
That's the hardest part of this job, man. Property management.
Oh, absolutely.
I don't know how the hell you do it. I'm going to be honest with you.
Well, I'm going to give a shout out now to my team, because as I said, I mean, there's been an evolution, but right now I am blessed to have a great team of 5 employees. 2 are property management and 3 are maintenance. And that's, that's the secret to anybody's success, is having the right team.
Yeah.
I'm sure you seem to have a great team here yourself, so I'm sure you understand, but yeah, you can't do it yourself.
Is the lady that was still with you about 8 years ago still with you today?
No, I don't think 8 years ago wasn't the same person, but the ones I have now have been several years already.
Awesome.
So yeah, it's great.
I was just watching this Facebook reel from one of my mentors. He owns a couple hundred units, and he was talking about property management. Mm-hmm. He goes, people ask me all the time, should I manage my own property? Should I hire property? Should I start a property management company? And he goes, stay the hell away from property management. It is a freaking nightmare. So, dude, kudos to you because it helps when you're that hands-on and you're the one making sure things get done, tenant turnover, lease up. Nobody cares more than you.
Right.
So the fact that you were able to do that is a huge accomplishment. I guess, can you kind of walk me through some of the pros and the cons and some of the challenges that you had to overcome by in-housing this?
Yeah, so, it's interesting. From the beginning, you get a lot of advice from people, most of it unsolicited, right? Yeah. And it's contradictory advice. Some people will say, you got to manage everything yourself because you have to be hands-on and no one cares as much as you. And then some people say, you have to focus your time on the higher value activities and you have to outsource the property management. So I'm getting these contradicting advice at the same time. And the problem is they're both right. So what do you do? But it was important for the learning, for my own learning with property number 1, I'm doing it myself. All right, that, yes. And then quickly moved to hiring another company. And that was useful because I could learn kind of what they're doing right and wrong. And then, but my goal always was to get to the hiring of an employee as quickly as possible. But by the time I got there, I had learned enough to be able to train that person and to guide them and provide, these systems in place, the processes how I wanted to do things. And so that, and having the right person is, but you can't, I don't think you can do that day one. I think you have to learn. You have to get in the weeds a little bit and then get out of the weeds,
Yes.
So, and then once I have the right person and they're trained on the systems and processes, then I turn them loose. Then I say, like, you know that you're the expert on this property. If you're my property manager, I'm asking you what I should do, not the other way around, because you're the expert on this property now. So that's why you're on my team. Right. And then, if it's a person, it has to be a person that I can trust to make those decisions and have the right judgment.
Gotcha. I mean, it's half the battle is finding the right person.
Sure.
The right personality, the right temperament,
mm-hmm.
the right subject matter expertise, intelligence level. Did you find someone brand new, or did you hire somebody with existing experience?
A little bit of experience, so not brand new, but also early career.
Okay.
Because I can't train somebody from zero, but but I also don't want somebody who's done it for so many years that they're set in their ways and they don't know anything else. So the right balance there. I come in, we have a way that we do things, and hiring somebody internally, by the way, didn't save money versus hiring a company, but it improved quality for sure, and improve the consistency. You know, you want to be able to treat all your properties and your tenants the same way, and be able to kind of oversee that, how that goes, and so there's value in having that.
I like that you said earlier that you did your own property management initially to get in the nitty gritty, and then you hired third party management, leveraged their tools, their technologies, anything that you could learn from them. And then the last step was bringing that
In-house.
totally in-house with an employee on staff.
Right.
I guess I don't know if that was a planned, was that planned for you, or was that something that it just kind of fell together?
No, it was planned. I mean, and those were the steps I felt I had to take because I knew I'm not, you know, my personality, I'm not a micromanager. I'm probably the opposite of that, but I don't want to hire somebody and say, oh, I have no idea what I'm doing, you figure it out. I mean, I want to be able to guide them from the beginning on how we're going to do things here. So I needed to learn. I needed to gain that expertise through first doing it hands-on and then hiring a third party.
I think I love that because I don't really run asset management for my company. We own about 188 doors now, and I'm very rarely involved in asset. My business partner, the better half of me, Eric, he's not here today. Thank God for him, because he really bears the burden. That's the hardest part of the job, and I get to do the fun stuff sometimes. I get the acquisition, I negotiate, I structure the deal, and I'm lucky to have him. But what we did was we did the same thing. We took down a couple 2s, 3 families, 4 families, 6 units, 10 units, and we aggregated about 100 units self-funded and self-managed. And we were like, this is fucking hard. Well, I can't really speak for that, but just seeing him operate day to day is a real miracle, because he's not only doing that, but he's running another company. He's running 2. I don't know how he does it. He's a beast. But so then we bought a large asset out in Westchester County, 79 units. Yeah, 79 units. And we hired a phenomenal management company. And they are, quite frankly, they're way better than us.
Well, good. I mean, so you did the right thing by hiring them, right?
And if we had hired her earlier on and brought in phenomenal management for our existing portfolio, then we would have been able to leverage the learnings. And then, so the last step for us now is, okay, you're going to come here, you're going to manage our portfolio, you're going to help us get things right, and like really systematize weekly reporting, all that good stuff. And then we're gonna part ways. And that's kind of laid out already up front. He knows the deal. And so that's the third step for us, is eventually taking on this behemoth of a job, and start to manage our entire portfolio. But I think there's a lot of wisdom to be had there. That's a great lesson for those that are looking to grow your real estate portfolio. You mentioned that you occupy the space that you occupy one of your office buildings that you own.
Yeah. So I moved into my own building, but I've done that a couple times in a row now. So that's kind of been a strategy.
Really?
All the office hacking, if you will. Like you've heard of house hacking, right?
Yeah.
Well, house hacking is for people that probably don't have families and want to move around every few years. And but I think when we met and worked together, I think the office, we were renting a small office in Bloomfield on Bloomfield Avenue. And so we ended up moving from there to a building that we bought. So we built, it was a small mixed use building in Orange, 2 commercial, 2 residential, needed full rehab. And bought it, started the rehab. I didn't even plan to do this when we first bought it, but then halfway through the rehab, I realized, hey, this would actually make a good office for me. So we moved in to one of the commercial units and rented the other one and the 2 apartments as well. Then a couple of years later, ended up selling the building and staying on as a tenant for another year. So being a tenant in that building helped us sell the building, because we were 25% of the building. So it, and we were a great tenant, right? Obviously. So, so we sold the building, stayed on, and then did the same thing again, bought another building, a much larger, 14,000 square foot building in West Orange, which was about 1/3 vacant and needed work as well. So we went in there, moved in, started leasing it, fixing it up, leasing it up. And we actually moved from one office to another within the building once we had somebody that wanted to rent our office. So we kicked ourselves out of that office, moved to the other office, and that's where we are. So including our office, we're fully occupied now, including that cannabis dispensary. They're one of the tenants too. So it's a very funky building, but we plan to hold this one for a while. But it was just being there was helpful. For the leasing as well. We're on-site management for our own building, and that's just helped in a lot of ways to get things moving in the right direction there.
Very cool. Very cool. What are some of the strategies and challenges of office that you've had? I mean, you've taken buildings that were underperforming, and you take them to full stabilization. You're doing the CapEx. I mean, what are some of the challenges you had stabilizing this office mixed use as opposed to, I guess, just a regular multifamily building?
Well, with multifamily, which we have some of, if you're renting an apartment, you have to fix it up yourself, right? And then it's never a problem to rent an apartment, in the areas we have apartments for sure. But so definitely, it takes longer to lease an office space. But especially for the larger tenants, they do the work themselves most of the time. So we had a medical building in Bergen County. We still have, and we had about 25%. Large office was about 25% of the total square footage of the building, and we were having a little trouble renting it during COVID. Then a dental practice came in, and they didn't care what the place looked like because they were going to renovate it to their standards. And it is a beautiful, I've never seen an office like this, a gorgeous dental practice. And so all that worrying about what the place looks like and all that, it didn't even matter. It was just, they liked the location. It was the right size for them. They came in and they did what they had to do. And so, it was a challenge to lease it, but some of the benefits are they come in and they do the work, and then now they're here for 20 years. Of all the dental practices, of all the medical practices, types of tenants, I think dentists are one of the best because they spend a lot of money, they invest a lot in fitting out their space, and then they never leave. And when they do leave, when they retire, they sell the practice to another dentist, and then you basically have somebody forever there in that space. So we have 3 dentists now as tenants across all our properties, and they're great.
That's amazing. Congrats on that. That's fantastic. What when you're taking down these deals, I have no office experience whatsoever. I worked at Kane Anderson. We did some medical office. But unfortunately, my tenure wasn't long enough to get to that asset class.
Right.
I did more senior housing and self-storage. But the medical they made a ton of money on medical office. It's such a niche asset class with tons of demand. And the trend is that it's going to continue to grow. There's going to be more demand than supply on the marketplace. So, the supply-demand equilibrium for the next few decades won't be met. Right. So great asset class, great choice. I expect nothing more from you than to pick a good one. So I guess the question is, how long does it take to typically lease up one of these spaces?
Well, for the larger spaces, it can take longer, a few months. 6 months or something.
That's not bad.
For the small, we have another building that has small spaces that we get, a therapist, that type of, which is like quasi-medical, I would say. And those tend to, be more similar to residential, that they're quicker to lease, but they're shorter tenure of the tenants. So, it's been a mix. I'll also tell you the other asset class that I, talking about being a contrarian a little bit, is during COVID is restaurants. I mean, so right now we have 6 restaurants. and all of them survived COVID, so I'm proud of that. And that was another one that people said during COVID, oh, restaurants are dead. You can't invest in restaurants. I said, wait a minute. Like, people are going to go back to eating at a restaurant at some point. And restaurants is another one that once, so the tenant may come and go. That's true. They may fail. Restaurants fail all the time. Mm-hmm. But the kitchen is still there. So you're going to be able to get somebody else in there. And, we've only had one that turned over ownership, but we had a new tenant come in and they changed the concept and renovated, whatever. But that's another one where, once you have it built out the right way in the good location, you're going to have a tenant at some point.
I love that, man. You always thought outside the box for as long as I've known you. Like, I remember going to your office in Bloomfield, going up those stairs. I think it was a left turn.
It was a left turn, yeah.
And then it was a scary
place. We've come a long way since then.
But, yeah, I mean, it looks like you've had a ton of success, dude. So I'm so thrilled for you.
Thank you. Good memories there, though.
Dude, it's always the hardest times that you look back on and you go, that was the best times, because
absolutely.
That's when your grit was tested. That's when your fortitude and what you're willing to put in is tested, and that really it's like throwing a 12-year-old and sparred out into the forest and saying, "Come back with wolf, like a wolf on your shoulders, or don't come back at all," right? Yeah. And you became a man. You come out like a beast. You can't be stopped after you overcome those hard times. But so when you're looking at, because to be honest, Daniel, when I see a mixed-use building, I go, ugh.
Oh, no, I go the opposite of that. I go, wow, let me take a look at that.
I love that. Dude. Yeah. Teach me, like, give me, like, what are you looking for when you see office, or what are you looking for when you see mixed use? What do you see? You obviously have a different pair of glasses than I do. What are your glasses? What are you looking for when you look at these assets? Demographically, is it traffic count? Is it curb appeal? Like, what are some things that you're seeing that I'm not?
Well, in the past few years, office has been the main asset class where you can still find cash flow. All right, so right now, especially with the rates where they are, I'm not seeing it in multifamily. So and I've always prioritized cash flow, and only recently been, willing to look more at the upside than cash flow. But that's why I was looking more at office, because the current cash flow was there. And if, the building is 75% occupied and it's still cash flowing, I mean, that's fine with me. And I'll see more upside than downside there. If like, we purchased something at the end of 2021, so like, well, if these tenants have survived COVID this long, they're probably going to stay. And then the other 25% of the building, we can up. So looking for, office was all about cash flow. I only look at, upper middle and income and higher areas with office. With apartments, it's more of a range. And then, the mixed use is great, because you have a blend of, you have apartments. So I'm talking about more retail and apartments, or restaurants and apartments. The apartments, you'll have zero vacancy pretty much, but the rents will be limited, right? And most of the towns where we operate have rent control, by the way. So, but the commercial is the opposite. You're going to have more volatility. You're going to have more vacancy, more risk, but you're also, with the economy improving, you're going to have higher rents, and you're going to be able to upgrade your tenants more significantly. So you have a blend of those two. That's why I love mixed use, because you have, and it's just like, you have something for everyone. We have restaurants, we have hair salon, nail salon. I don't go to either of those, but like barbershop, but commercial real estate is a lot of fun, though. You get to meet, interesting people doing interesting things, and help them be successful with their business.
That's really cool, man. That's really cool. So you're a marketing. You're one of the smartest marketers I know.
Thank you.
And I think that's kind of what you did when you were at ZS too, right? You were on the marketing consulting side.
Yes.
I remember you taught me how to aggregate tax liens.
Oh, right. Tax liens, yeah.
And I remember taking that list and sending out my first direct mail campaign from it. Till this day, I still aggregate tax liens.
How's that worked out?
It's usually my high, if you're listening to this is gold right here. My highest fees, my biggest deals, my fattest profits have come directly from this list. Okay. If an owner has a tax lien and they're just a few months away from foreclosure and losing it, but they have equity, they're not going to want to just lose hundreds of thousands of dollars in years that they put into the property. They're going to want to monetize or get paid nothing, right? Mm-hmm. And so if you could find these three categories in one owner, they're going to foreclosure in the next 3 to 6 months, they have equity in their property, and they inherited it over the last 2 years, my golly, are you going to get yourself a deal? You should be paying me for this one. This is a gold mine. So for you, Daniel, thank you for teaching me, by the way, teaching that to me. But if you are, I'm sure you have some unique strategy to lease up that most people don't know. And if you don't feel totally comfortable sharing,
I feel totally comfortable, David.
Let's go.
You've made me feel totally comfortable here. I appreciate that.
I love that. So can you share some sort, what are you doing? What are some strategies that you implement to lease up retail and office? Because a lot of people are failing at this.
Yeah, okay. So depending on the property and the size of the unit, sometimes I do put it out with brokers and sometimes I don't. So even though I'm also a licensed realtor, I do work with other realtors just to help me access their network. So it's worth it sometimes to do that, especially for the larger units. But we're blasting, social media. We're doing, LoopNet. We're doing for residential, it's Zillow, Trulia, and those. But for commercial, it's more LoopNet and the MLS, and also just being involved in the community. So we're mostly centered on around Essex County. We have a lot of properties around West Orange, Montclair, Bloomfield. So we get involved with, let's say, the towns and the downtown association, and we hear this tenant's thinking about moving somewhere else, or we have a space that could suit them, and these kind of things. So it's a lot of word of mouth, which takes work, but it pays off.
That's probably you're probably getting tons of benefit from that network.
Yeah. And fortunately, we haven't had a need for it that much because we haven't had a lot of turnover really for, especially for retail. There hasn't been a ton of turnover. Office, here and there, but we've look, half the battle is keeping the tenants you have, by the way. So that's really, that's where I have to acknowledge my team in the service that they provide to the tenants that we have, that helps retain them. That's the first thing, so we won't have as many vacancies.
Right. Shout out to the team. You guys doing a great job. You guys doing a great job.
Go team.
Go team. Daniel, I remember when we first met, if I recall correctly, you were a 5-year exit. You were buy, value add, exit 5 years, the standard private equity syndication model. Have you transitioned at all to more of a core, like a long-term play, or, dealing with different timelines of investors? Have you deviated at all from that strategy?
Well, yes, because, when I was, and still now, when I first starting in now, I don't feel it's right, or I don't think you can just tell somebody we're going to keep your money forever. You have to give them, whether it's 5 years or more, you have to give them some time horizon. And so there have been now several investments that have hit that 5-year mark or 7-year mark. And what's happened is that most of the time investors say, so I've come to them and say, hey, I know I told you that we were going to exit in 5 or 7 years, but I don't see a good opportunity now. I think, we're paying dividends. Things are going in the right direction. I think we need to hold it longer. And most people say, all right, I'm on board with you. But for those who want to exit, we could work it out where we buy them out. And we've done that. We've done that, and everybody's happy because the investors that are staying in get to increase their share, right? And usually we can structure it so they're not actually out of pocket. We just, the distributions that are being paid out will just go to the exiting partner. Okay, so it's not like everybody's coming out of pocket. And then if you're staying in the deal, then you just don't get those distributions, but your equity is increased.
That is so smart. I've never ever heard of buying out a partnership by redistributing the distributions and creating more for that exit partner, so they get more cash flow in the short term. That's a really smart way to do it. I would hate to buy out an investor and lay out that personally, or have someone else do that. So I guess that really is a very, very good way to do it. Thank you for that.
Right. Yeah. I mean, a lot of people are not concerned with getting that distribution check, but they don't want to come out of pocket. So we're just trying to help everybody meet, their goals here. So we can usually work it out.
I love that. There might come a time where I'm going to have to do that. So
all right.
Good stuff, man. You're always dropping bombs for me. Thank you.
All right.
I have one more question, but before we wrap up, interest rates, I mean, it's been record breaking how fast they've gone up over the last 2 years. How are you navigating this current interest rate environment?
So whereas I started off focusing on cash flow, now I've found that because the prices haven't dropped enough to compensate for the higher rates, that the cash flow is not there. I mean, there are deals where at the price that you can realistically buy a property for, you're not going to cash flow. So therefore, besides not buying anything, but if, what I am looking to buy is focus more on the upside. So, properties, and when I say upside, it's not this magical, the market's going to change that's out of your control. I prefer something that is property's been underutilized, underperforming. Again, the mixed use is great because you have apartments that are below market rent that as people move out, you can renovate. You have tenants that, commercial tenants that maybe there's vacancy or maybe they're under market as well. So things that are more under your control. If you can buy a property, I still like to break even. I still don't look at properties where I'm going to be losing money every month. But at this point, you can't ask for too much with the rates the way they are. And I don't like this whole negative leverage, borrowing at 8%, investing at 5% cap rate, but if you can break even and you have some upside over time, great. I think that's what we can look for now.
It's really amazing that you say what you say. You've taken a lot of the philosophies of highly successful, multi-generational investment firms, and you've had the discipline to stay in that zone, right? I remember listening to a podcast about a year ago, and I'm forgetting the name of the company, but it's one of the largest real estate private equity firms in the world. And the key for them was exactly what you said. Buy for cash flow today, right? Make sure there's room for value add opportunity. Can you decrease expenses? Can you increase top line income? And is this in a market where there's strong growth, like Montclair, Bloomfield, some of the areas that you're investing in? They're definitely positioned for, like, it's the upper middle class, right?
Sure.
So super awesome that you're staying disciplined in your investment approach. Have you ever considered seller financing, creative seller carryback?
Yeah, we've done it a couple times actually.
Really?
Not recently, but early on when, when property, especially when properties with high vacancy and where banks shy away, that can be a good, with usually 1 year term is enough to get things turned around where you can refinance into a bank loan. But yeah, and that's something that also makes sense today with the higher rates. So yeah, it's worth exploring for sure.
Very cool. For the audience, if they want to invest with you, what kind of returns in terms of cash flow, I guess cash on cash returns can they expect over a 5-year horizon, and what kind of total returns or IRR are you targeting?
So we historically, we had projected and we've hit or exceeded about 15% IRR on whether it's small multifamily or mixed use. But as I mentioned, we haven't really sold a lot, so it's it kind of remains to be seen, and that means that we see even higher potential than that in the future. I mean, if we thought we could sell it for 15% IRR, we would, but we think we're going to do better than that going forward. So we've held on to a lot of things. Now what you buy now, it's hard to promise an IRR these days because of where the rates are and volatility and stuff. So being very selective about upside. So definitely there's a little more risk now, but with the right asset, you can still opportunity.
Going into 2024, Daniel, what are some of the goals that you have in mind?
So David, I'm looking to expand by partnering with other investors. So I've from the early days of managing the properties myself, I've done a lot of the hands-on work. But there's a lot of great people out there that are, maybe early career, very hungry, very motivated to invest in real estate. I want to be able to partner with them, whether it's by an equity investment or adding some of my expertise, and be able to grow that way. Not necessarily every property managed and run in my office, but be able to grow a little bit by working with other operators.
Awesome. My mentor, actually, one of my paid coaches, I paid him $20,000 to coach me, and he signed the Fannie Mae loan with me because I wasn't qualified. I had enough liquidity and AUM and track record, but I didn't have enough experience on deals that big. So now that I've done that, I'm a Fannie Mae guy, and I can start offering that service. But so yes, just to be more clear, right? It's hard to get bank financing. It's hard. You can't pay enough for great mentorship, and to have someone that has been a true mentor to me and just an overall great guy, man. I think that's a huge value add that a lot of people can get. For the audience, if they want to reach you, whether they have a deal, if they want to invest, maybe they're a lender and they're like, I got great office and mixed use products. If the people want to find you, reach out to you, Daniel, what's the best way to get in touch?
Yeah, thanks, David. So we're about to revamp the website, but pymstone.com, that's my management company, pymstone.com. So we're on Facebook and I guess it's called X now. I still can't say that. Twitter, X, X and Facebook. Haven't gone into the gram yet, but I hear I'm supposed to. So, but Pymstone Realty on Twitter and Facebook.
Awesome, Daniel. Honored to have you on the show. Great catching up with you, man.
Thanks so much, David.